Let's do it. If anyone's late, they'll just have to play a bit of catch up, maybe view the recording. So, hello and welcome everyone. My name is Jack Brown. I'm one of the partners at AP Group. Thanks to everyone who's tuning in again, and welcome to any new audience members. And a very special hello to you too, Andy.
Thanks, Jack. Hi, everyone. Thanks for joining. Looking forward to having a chat today about options to increase borrowing capacity.
Before we kick things off in earnest, AP Group acknowledges that our office is on country of the people of the Kulin Nations. We wish to honour the connection to country of all Aboriginal and Torres Strait Islander peoples and pay respect to their traditional custodians, elders past and present. We'll follow the same structure as previous episodes today, with Andy discussing the key topics initially, and then we'll hopefully have time to address some questions at the end. On that note, please use the Q&A function at the bottom of your Zoom screen to submit your questions. And as I said, we'll endeavour to get through as many as we can. And over to you, Andy. What's on the agenda for today?
Brilliant. Thanks, Jack. So really what today's session is all about is giving people some intel on some options to maximise borrowing capacity within the confines of what is affordable for you. So that can be useful if that extra capacity can help you work towards your goals. But what the session certainly isn't about is encouraging people to borrow more, and also not about borrowing at a level that people can't afford. It really is just giving you an idea of what some of the options are and some of the levers that affect borrowing capacity. There's three key things we're going to cover. So the first is a recap from episode 1, where we'll have a look at how banks assess finance applications. The second, again, is a bit of a recap on how banks assess borrowing capacity specifically. And then third is really the meat of the session, where we're going to look at what some of those options are to impact borrowing capacity levels.
All right, terrific. Thanks, mate. Let's kick things off.
All right, so we'll dive into it. So we'll jump onto slide 5 there and have a look at how banks assess applications. So again, recap from episode 1. We'll make that recording available for anybody who wants to dive back into that for a bit more detail. But essentially, banks will look at capital. So that's the assets that provide security for the loan, and also the percentage of cash or property equity deposit that an applicant needs to present with. The second is where we'll spend the bulk of our time for the presentation today, and that's around capacity. So put simply, that's being able to evidence that you can meet the repayments for the loan that you're seeking to take out. And then thirdly, and importantly, banks will have a look at the character of the applicant. So here they'll look at if you've had financial facilities in the past, let's say a home loan or a car loan, that you've been able to meet those repayments, and that you've maintained a clear credit record, so staying on top of your bills and things of that nature. Essentially, being able to give confidence to the bank that based on your past behaviour, you're a safe candidate for them to loan money to moving forward.
All right, terrific. Thanks, Andy. As you said, we did cover this off. This was the topic in episode 1, so I think we should push on and get to the meat of today's presentation.
Terrific. So in terms of how banks assess borrowing capacity, most commonly what the banks will look at is a simple formula. So looking at all the money coming in, so your salary, business profits, if that's relevant, and any other income like rental income, for example, if that's relevant to you. So look at all of that income, and then look at all of your expenses. So the cost of the loan that you're seeking to take out, your monthly living expenses, so grocery bills, etc., that you require to live. And then finally, any other financial commitments that you have. And so when taking all of that income and then taking away all of those expenses, they'll look to see, is there a surplus at the end of it? The key things to be aware of, within this equation of how banks will look at borrowing capacity is that they'll assess on serviceability or affordability interest rates. So typically in that 9 to 10% range. So what that means is if you do have a high level of other commitments, so credit cards, personal loans, car loans, for example, you need to be able to prove that when you're applying for a loan, not only can you meet all of those other commitments, but you can meet the loan that you're seeking to take out as well. So it does make it more difficult to get approvals if you do have a high level of other commitments.
Thanks, Andy. I think that's a pretty simple formula for people to get their head around. And I guess the next obvious question is, what can people do to impact those formulas and I guess ensure that the outcome is more favourable and they're able to secure a loan?
Brilliant. So I mentioned that that formula is really money coming in and then money going out. So when we talk about ways to increase your capacity, there's three things that we'll have a look at today. So the first of those is the impact of liabilities. The second is the impact on capacity of reducing living expenses. And then finally, an option that's not necessarily available to everybody, but to understand the relativities, what increased income will do to borrowing capacity as well. So we'll dive into the scenario. So what we've got here is an example scenario of a couple, and stress here that we're working through generalized examples of what certain measures can do for borrowing capacity. Again, we're not giving individual advice or encouraging people to take these steps. Rather, we're aiming to provide a level of understanding around how banks will assess borrowing capacity. And we'll use this example scenario as our basis. So what we've got here is a couple with no dependents earning a combined $200,000 a year. They're spending $6,000 a month on their living expenses. They've got a couple of credit cards at $10,000 limit, so a total of $20K limit there, and then a $50,000 car loan on a 5-year term with $800 a month repayments, and then also a HECS loan with a $50,000 balance. So what we've got here with all those inputs, this example couple can borrow somewhere in the range of $510,000 to $550,000. So what we'll do now is start moving through some examples of how you can impact that with certain changes to liabilities. So the first one is really low-hanging fruit, the most obvious one. So what this couple has done here is gone from 2 credit cards to 1 and reduced the limit from 10K to 6K. So a total of 6K credit card limits versus 20. And you can see that has between a $60,000 and $80,000 impact on borrowing capacity. So this is a change that, depending on your circumstances, won't necessarily impact your lifestyle. You've just got lower credit card limits to work with, but it does have a material impact on borrowing capacity because banks will rightly assume that people will fully draw the credit limits that are available to them. So we'll jump onto the next slide now and have a look at the impact of the car loan. So here, this couple has paid out their $50,000 car loan. And you can see that by reducing that $50,000 car loan liability, the impact on borrowing capacity, it adds between 100 and 135K, depending on the bank. Critical piece of information here is that whilst car loans will typically have higher interest rate costs in the short term, if you are going to spread those repayments over 30 years, then you're likely to incur higher interest costs overall. So if that car loan can be paid out with savings, then brilliant. But if you are substituting the car loan for putting that on top of your home loan, it is just worth being aware that that's likely going to come at a higher interest cost overall, unless you do pay it down faster than the 30-year loan term. So we'll jump onto the next slide now and have a look at HECS. So again, $50,000 HECS liability that's been paid out. And you can see there from the slide that the borrowing capacity change is between $90,000 and $110,000. So we're looking at capacity now up in the range of between $760,000 with one bank and $875,000 with another. Again, really important to note that spreading HECS repayments over 30 years will result in higher interest costs overall. So what you need to consider is whether that is the right thing for you in terms of meeting your goals. Essentially, whether those increased costs are worth the benefit of the higher capacity, if that's what you need to work towards your goals. So we'll jump onto the next slide and have a look at living expenses. This is a really big one in terms of the impact that it can have. So what we've got here is this example couple have reduced their living expenses from 6K to 5K per month. And the impact on borrowing capacity is quite profound. So as you can see there on the slide, an increase between $110,000 and $130,000 in capacity, excuse me. Couple of key things to flag here. Any change in living expenses obviously needs to be sustainable. So if you've got discretionary things in your living expenses that aren't things that you necessarily need to maintain an acceptable standard of living, it might be like Uber Eats, for example, where you could trim those costs and evidence that you can do that ongoing. Then there are increases to borrowing capacity that can come off the back of it. through any finance application, your broker will make inquiries into your living expenses. So having a look at statements, credit card statements, for example, along with other things, just to make sure that those declared expenses are right and sustainable moving forward. And then also important to note that the bank will always assume a minimum level of expenses. So there's only so far down you can go with your living expenses before they sort of hit those minimum thresholds as well. So any change you make here, it's important that it's done in a way that's sustainable for you ongoing, but can have a material impact on borrowing capacity with lower expenses as part of the application.
Thanks, Andy. And I think we've now covered off two, I guess, of the three inputs for the capacity assessment formula, which leaves us with the final component of your income. But just before we get to that, the couple of questions that come through that I think might be worth addressing, which is essentially, people asking, why does such a small reduction in your expenses result in a disproportionately large increase in your borrowing capacity?
Yeah, sure thing. So it's a good question. The key thing here is that banks will assess any liabilities that you've got at those stress test rates, or if it's credit cards, they'll assume those credit cards are fully drawn. So removing those limits, not only are you removing the bank having to consider that you've got to repay that loan, but you've got to repay that loan at a stress test interest rate, which obviously soaks up quite a bit of your capacity.
Terrific. Thanks, Andy.
So income, so I mentioned at the top, this is not a scenario that is necessarily available to everybody, but what we wanted to show here is just the relativity of what increasing income can do. So here, applicant 2 has taken on an extra shift of 5 hours a week, which would increase income from $80,000 to $90,000 per annum. And you can see there that adds capacity of between $70,000 and $80,000, depending on the lender that you're working with. So it can make a big difference. So if your circumstances permit an extra PAYG shift to take on, it can have a material impact on your borrowing capacity. We did spend a bit of time in episode 1 on looking at the types of income and making sure that the income will be accessible to lenders. So I'd encourage people to go back and have a look at that episode 1 if you want a bit more detail on income and how banks will assess that income. It's worth diving back and taking a bit of a look.
Terrific. All right, so I think that's the end of the summary, and I know you love a good soundbite, Andy. So if there was some key takeaways you wanted to leave with the audience, what would they be?
Yeah, brilliant. So let's go through those. So the first thing we always say is something that you can do today is to complete that capacity assessment. That'll give you an idea of your current position. And even if that current position's not where you need it to be to get to where your goals are, at least it gives you a stake in the ground and lets you know what you need to do to work towards where you want to be. The second, so as I mentioned earlier, we've gone through what some of the levers are to impact borrowing capacity in generalized examples. If people did want to consider their own circumstances and get some advice that's specific to them, we'd be happy to work with you to look at some changes that you could potentially make to increase your own borrowing capacity to help you work towards your goals. And then finally, you'd notice as we went through the slides, the disparity between what different banks will lend in terms of capacity will vary greatly based on how each bank structures their policies and assesses different scenarios. So work with your broker to explore the right lender for you, which will cover, not only borrowing capacity, but also loan structures, rates, repayments, etc., to make sure you've got the best possible lender for your circumstance.
Terrific. Thank you, Andy. Conscious of the time, but we've got a few minutes left, and we'll try and get to some of the questions that came through on the thread. I guess one that seemed to be asked a few times is there a tool available for people to monitor or better manage their expenses and liabilities?
Yeah, so it's a good question. So as part of our capacity assessment, we do provide some tools to break down your monthly expenses and outgoings to give you a categorized view of what that looks like. So that's probably the best place, I'd say, to start to give yourself a bit of a more granular picture.
Terrific. And then I guess another question, a few of the questions related to, I guess, existing residential property used as security. So people who are in their own equity in their own home looking for another loan, and then also, I guess, family members who might have an asset. And generally speaking, that's the parents in the applications that we see.
Yeah, so it's a good question, something we see quite a lot. So I mentioned at the start, the banks will look at three things principally, and the first of those was around collateral, so the assets that provide security for the loan. Generally speaking, a bank will require an applicant to turn up with X% deposit by way of cash or property equity. So if you've got a property with equity in it and you wanted to use that to borrow for the deposit that you need to bring to the application, that's permissible. Most banks will allow you to do that. So rather than, say, turning up with $100,000 cash, for example, you would borrow that $100,000 against another property. The key thing here is that then you also need to tick the capacity box, so your ability to repay that deposit money and also the primary loan. But it's a scenario that is quite common and something that we could help people through. The second part of the question was around using guarantor security. So this is a bit more of a tricky space. We do see it quite a bit. The best possible summary is that the guarantor, you need to be able to demonstrate a beneficial interest for the guarantor. If that scenario was relevant to people, we'd be very happy to catch up and run through some specifics with people that's specific to their individual circumstance.
Thanks, Andy. And look, I'm conscious that we can't get through all of the questions, and some of them probably require a more detailed response that we can give in this particular format. So I think that will conclude the webinar for today. And a big thank you again to Andy and our finance team for putting the presentation together. And thank you all for attending. As we mentioned, if you've got any questions, you can reach out to Andy and Matt, and their details are on the screen. We'll also send out a recording of today's presentation again. And as part of that email, I think we're going to send another survey. And if you were able to complete that, that'd be really appreciated. It helps us, I guess, to improve on the presentations moving forward. And thank you, everyone, again.
Thanks, Jack. Thanks, everybody.